Picture this. You wake up Monday morning, check your trading account, and see red. Again, another week of promising setups that collapsed. Another round of stop losses hit. You tell yourself next week will be different, but deep down you know you're repeating the same mistakes. The market isn't the problem. Your approach is. The average retail trader loses 70% of their capital within the first year. Not because they lack intelligence or dedication, but because they're playing a game they don't fully understand. They chase hot stocks, follow Twitter gurus, and trade based on emotion rather than evidence. Meanwhile, institutional traders follow systematic processes that remove emotion from the equation entirely. This isn't about buying low and selling high. It's about understanding probability, managing risk, and executing a repeatable process that works regardless of market conditions. The formula exists. It's been tested across decades of market data, and today you're going to learn exactly how it works. Let's start with the foundation that most traders ignore: position sizing. Before you even think about which stock to buy, you need to know exactly how much capital to risk on each trade. The answer isn't 10% of your account. It's not 5%. For most traders, risking more than 1 to 2% per trade is financial suicide. Here's why. If you risk 10% per trade and lose 5 times in a row, you've destroyed 40% of your account. You now need a 67% return just to break even. Risk 2% per trade instead, and 5 losses only cost you 10%. You're still in the game. You can recover. This single adjustment separates professionals from amateurs. Calculate your position size using this exact formula. Take your account size, multiply by your risk percentage, then divide by the distance between your entry price and stop loss. If you have $10,000, risk 2%, and your stop is $1 away from entry, you can buy 200 shares. Not 300, not 500, exactly 200. This math isn't optional. Now let's talk about entries. The best traders don't buy breakouts. They buy pullbacks within established trends. When a stock makes a strong move up, wait, let it rest. Let weak hands sell. When it pulls back to a key support level, typically the 20-day or 50-day moving average, that's your entry zone. Combine this with volume analysis. You want to see high volume on the initial move up, then declining volume on the pullback. This pattern tells you the buying pressure was real, and the pullback is just profit taking, not a trend reversal. When volume starts increasing again as price bounces off support, that's your signal. Add one more filter, the overall market trend. Check the S&P 500, the NASDAQ, and your sector index. If all three are in uptrends above their 50-day moving averages, your probability of success just increased significantly. Trade with the current, not against it. Individual stock selection matters far less than trading direction. Your stop-loss placement determines whether you survive long enough to profit from your edge. Most traders place stops at round numbers or recent lows. This is exactly where market makers hunt for liquidity. Instead, place your stop just beyond the low of the pullback pattern, typically 1 to 2% below a key support level. Give your trades room to breathe. A stop placed too tight will get hit by normal market noise. A stop placed too wide means your position size is too large. Find the technical level that invalidates your thesis. That's where the stop belongs. If price hits that level, you were wrong about the setup. Accept it and move on. Profit targets require a different mindset than most traders possess. The goal isn't to maximize every single trade. It's to capture consistent, repeatable gains that compound over time. Target 2 to 3 times your initial risk. If you risk $1 per share, target $2 to $3. This creates a favorable risk-reward ratio that allows you to be wrong 40% of the time and still profit. Use a scaling exit strategy. When price reaches 1.5 times your risk, sell 1/3 of your position. Move your stop to break even. Now you're playing with house money. Let the remaining position run toward your full target. If it reverses, you still captured a profit. If it continues, you maximize your gain. The hardest part of trading isn't finding setups. It's managing your psychology when you're in a trade. You'll face the urge to exit early when you see profits. You'll want to hold losses hoping they'll recover. Both impulses destroy accounts. Create rules and follow them without exception. Document every trade before you enter. Write down your entry price, stop loss, target, and the reason for the trade. This creates accountability. When you're tempted to break your rules, you'll have to consciously acknowledge you're violating your own system. Most traders won't do it once it's written down. Backtesting isn't optional if you want consistent results. Take your strategy and apply it to historical price data. Go back 5 years. Mark every setup that met your criteria. Record the outcomes. Calculate your win rate, average gain, and average loss. If the numbers don't show profitability over hundreds of trades, your strategy needs work. Most strategies that seem good in real time fall apart under historical scrutiny. You'll discover your entry signal works great in trending markets, but fails in choppy conditions. You'll find your stop placement gets hit too often, or your targets are too aggressive. This feedback is gold. Adjust your approach before risking real capital. Paper trading is worthless if you're not emotionally invested. The point isn't to practice clicking buttons. It's to practice following your rules when money is on the line. Start with small position sizes, small enough that gains and losses don't affect your emotional state. Gradually increase size as you prove consistency. Risk management extends beyond individual trades. Never have more than 5 to 6% of your total capital at risk across all open positions. If you risk 2% per trade, you can have 2 to 3 positions open simultaneously. This protects you from correlated losses when the entire market sells off unexpectedly. Diversification within trading is overrated. You're not building a retirement portfolio. You're executing a tactical strategy. Focus on 2 to 3 sectors that show the strongest relative strength. When technology is leading, trade technology. When healthcare is leading, trade healthcare. Don't force trades in weak sectors because you think you need diversification. The best trading opportunities happen during the first 90 minutes after market open and the final 60 minutes before close. The middle of the day often features low volume and erratic movement that traps traders. If you have a day job, focus on swing trades held for 2 to 10 days rather than day trades requiring constant monitoring. Earnings season creates both opportunity and danger. Volatility spikes around earnings announcements. If you're holding through earnings, understand you're essentially gambling on a binary outcome. Most professional traders close positions before earnings or trade only the stocks announcing earnings, using options to define risk. Options add leverage and flexibility, but also complexity. Before trading options, master stock trading. Understand that options decay in value over time. A call option can be right about direction but still lose money if the move happens too slowly. Start with simple strategies. Buying calls in uptrends, buying puts in downtrends. Covered calls and cash-secured puts offer defined risk strategies for generating income. Sell a call against stock you own, collecting premium while potentially selling at a higher price. Sell a put at a price you'd be happy to own the stock, collecting premium while waiting. These strategies work in range-bound markets where directional trading struggles. Avoid trading during major economic releases unless that's specifically your strategy. Fed announcements, jobs reports, and CPI data create unpredictable volatility. Price can gap beyond your stop loss, leaving you with losses larger than planned. Wait for the dust to settle, then trade the resulting trend. Market correlation matters more than individual stock analysis. When the market is in a strong uptrend, 80% of stocks rise together. When the market crashes, 80% of stocks fall together. Your brilliant analysis of company fundamentals becomes irrelevant if you're fighting the overall market direction. Sector rotation drives medium-term trading opportunities. As economic cycles shift, different sectors lead. Early cycle, industrials and materials. Mid-cycle, technology and consumer discretionary. Late cycle, energy and financials. Recession, utilities and consumer staples. Position yourself in front of these shifts rather than chasing what already moved. Technical analysis isn't mystical. It's applied psychology. Charts show you the collective behavior of all market participants. Support and resistance levels exist because that's where buyers and sellers previously agreed on value. These levels continue to influence behavior until something fundamental changes. Moving averages create dynamic support and resistance. The 20-day moving average represents the average price over the past month. When price is above it, short-term sentiment is bullish. When price is below it, short-term sentiment is bearish. The 50-day and 200-day moving averages provide intermediate and long-term context. Volume confirms or questions price movement. Price going up on high volume shows strong buying interest. Price going up on low volume suggests a weak move likely to reverse. Always check whether volume supports the price action you're seeing. Divergences between price and volume often precede reversals. Relative strength comparison tells you which stocks to trade within a sector. Pull up 5 stocks in the same industry. Compare their percentage gains over the past month. The top performer shows the strongest buying interest. That's your primary candidate. Avoid the laggards hoping they'll catch up. Trade strength, not weakness. Support and resistance aren't exact price points. They're zones where buying or selling pressure historically emerged. Mark these zones on your chart as areas rather than lines. When price enters the zone, watch for confirmation through candlestick patterns and volume before entering. Candlestick patterns provide short-term directional clues. A hammer at support suggests buyers are stepping in. A shooting star at resistance suggests sellers are taking control. A doji shows indecision. Don't trade patterns in isolation. Use them as confirmation within the the context of your overall setup. Trend lines connect swing lows in an uptrend or swing highs in a downtrend. When price pulls back to a rising trend line, that's potential support. When price rallies to a declining trend line, that's potential resistance. Trend lines break frequently, so always use stop losses to protect against false signals. Chart patterns like triangles, flags, and head and shoulders form as markets consolidate before making their next move. These patterns work because they represent the same underlying psychology repeating across time. Study these formations, but remember, they fail roughly 30% of the time. Position sizing accounts for this reality. Multiple time frame analysis prevents costly mistakes. Check the daily chart for the overall trend. Use the hourly chart to refine entry timing. Use the 15-minute chart for precise entry points. If all time frames align, your probability increases. If they contradict each other, skip the trade. The best setups require patience. You might find 5 potential trades in a week, but only 2 meet all your criteria. Take those 2. Ignore the rest. Trading more doesn't mean earning more. It usually means losing more through overtrading and forcing marginal setups. Maximum drawdown testing reveals whether you can stick with your strategy during rough patches. Look at your backtesting results. Find the worst losing streak. How many losses in a row? How much did the account decline? If those numbers would cause you to abandon the strategy, either improve the strategy or prepare yourself mentally for those scenarios. Recovery from drawdowns requires discipline. After a series of losses, the urge to trade larger to recover faster is overwhelming. This is how small losses become catastrophic ones. Stick to your standard position sizing. Let winners accumulate naturally. Forcing recovery trades extends drawdown periods rather than shortening them. Trading journals transform mediocre traders into consistent ones. Record not just what happened, but what you were thinking and feeling. After 3 months, patterns emerge. You'll notice you chase breakouts when you're bored. You'll see you exit winners too early after taking a loss. Awareness creates the opportunity for change. Your edge in trading isn't finding secrets nobody else knows. It's executing a proven strategy with discipline while others chase get-rich-quick schemes. The formula works because human psychology remains constant. Fear and greed drive the same patterns today that drove them 50 years ago. Compounding small, consistent gains creates wealth over time. A 2% average gain per week equals 104% annually. Most traders would be thrilled with 104% annual returns, yet they search for 50% gains on individual trades. Focus on the weekly process, not the yearly outcome. The outcome takes care of itself when you execute the process. Risk-adjusted returns matter more than total returns. Earning 50% with wild volatility and sleepless nights destroys your quality of life. Earning 30% with controlled risk and defined processes lets you sleep. Trading exists to improve your life, not dominate it. Tax efficiency impacts your real returns. Holding trades longer than 1 year qualifies for long-term capital gains treatment at lower tax rates. Frequent trading generates short-term gains taxed at ordinary income rates. Consider the tax implications of your trading frequency. Sometimes the best trade is holding a winning position longer. Technology provides tools previous generations lacked. Real-time scanners identify setups as they form. Algorithmic alerts notify you when your criteria are met. Automated order entry removes emotional hesitation. Use technology to enhance discipline, not to overtrade because execution is easy. Commission-free trading removed a barrier, but created a temptation. The cost of trading isn't commissions anymore. It's the cost of overtrading because there's no friction. Just because you can trade doesn't mean you should. Quality over quantity remains the defining principle. Market makers and high-frequency traders have advantages you'll never possess. They see order flow before you do. They trade with millisecond execution. Accept this reality rather than fighting it. Your advantage is patience. You can wait for high-probability setups. They must constantly trade to profit from volume. Correlation between assets affects portfolio risk. When stocks and bonds fall together, as they did in 2022, traditional diversification fails. Understanding correlation helps you avoid concentrated risk disguised as diversification. Different stocks in the same sector often move identically during market stress. Economic indicators provide context but rarely offer precise timing signals. Strong GDP growth generally supports stock prices. Rising unemployment typically pressures stocks, but the market discounts these factors 6 months in advance. By the time data confirms a trend, price already moved. Interest rates influence market leadership. Rising rates benefit financials but pressure growth stocks and real estate. Falling rates support technology and consumer discretionary but challenge banks. Adjust your sector focus as rate trends change rather than fighting against the prevailing monetary environment. Global markets impact U.S. stocks more than than most traders realize. When European markets sell off, U.S. markets often follow hours later. When Asian markets rally on stimulus news, U.S. markets frequently gap up at the open. Monitor international markets for clues about overnight sentiment shifts. Cryptocurrency markets trade 24 hours, creating opportunities and risks absent in traditional markets. You can be stopped out at 3 a.m. when you're asleep. Volatility exceeds stock market volatility by multiples. If you trade crypto, reduce position sizes accordingly and use tighter risk management than you would for stocks. The mental game determines long-term success more than technical skill. You can know every pattern, every indicator, every strategy, and still fail if you can't control your emotions. Trading exposes your psychological weaknesses. It forces you to confront fear, greed, and the need to be right. Meditation and physical exercise improve trading performance by reducing stress and improving focus. The best traders treat their mental and physical health as seriously as they treat market analysis. A tired, stressed mind makes impulsive decisions. A rested, calm mind follows the plan. Community and accountability accelerate development. Find traders slightly ahead of where you are. Share your trades, not for validation, but for feedback. When you know someone is watching, you're less likely to break your rules. Choose your community carefully. Avoid forums filled with gamblers celebrating lottery-style wins. This formula works because it's built on principles that never change. Math, probability, psychology, risk management. The markets evolve. New products emerge. Technology advances. But the core principles remain constant. Master them and you'll survive long enough to profit, regardless of what the market does next. Implementation starts today. Not next week when conditions are better. Not next month after you read more books. Today. Open your charting software. Identify one setup meeting your criteria. Calculate your position size. Place your order with defined risk. Execute the process. Results follow execution, never the reverse.